Hey Forex Fortune Hunters, it's Tom Wilmot. Today we're going to step back just a little bit from our technical patterns and we're going to discuss the most important issues surrounding the profitability of your account. You know, they say that 95% of traders fail, and here are the 6 top reasons people blow their accounts. So hold on to your hats. We'll get started right after this. Okay, Fortune Hunters, let's take these one at a time. It's very easy to avoid these common mistakes, and I can't tell you how important it is to try to get your trades lined up in the most intelligent way. The first way we can avoid blowing our account is to never enter a trade when momentum has begun to weaken. What does that mean? Well, using our multiple moving averages, we know that a crossover can occur on any time frame, and once that crossover occurs, we want to be taking the first or the second pullback into the bands. That's where our risk reward is lined up the best for us, and we'll be showing tons of examples of that as we move through some of the price bar charts that we'll see a little bit later. Okay, Fortune Hunters, here's a perfect example of not trading when the trend has run its course. We have this particular technical indicator, our 3 events template, on the wall here for a Euro JPY trade. Notice we have the first up thrust. This is the change in trend. We were downward moving, now we're upward moving. The first pull back into the bands is a great place to enter. Do you want to be entering up here just because you delayed because you were nervous about the trade? Of course not. The risk reward is completely blown away at this point. At the very least, we want to wait for the pullback here. This is a Friday, Saturday, Sunday kind of situation here on the weekend, then a continuation of the trend to the north. But even up here now, we've noticed that from the time that our trade started and our trend changed from south to north, we want to be very careful not to enter the trade too late in the transition times. The second way to blow your account is to enter a trade when no one else is around. Now, it can seem like maybe that isn't such a harmful idea, as probably there's not much volatility towards the end of the trading day. But believe me, you want to avoid that time. It's easy to just let your money trickle out of your account, even if it's $5 or $10 or $15 or $20 at a time, because of wasted trades, just because you're in an inactive period. You want to be very careful about that. In particular, watch out for Friday afternoons. There is no one left in town. The Asian folks are sound asleep. The Europeans have probably gone to the pub or out for dinner. There is no one around to trade the Forex after 3 o'clock or 2 o'clock on a Friday afternoon, especially if it's been a jobs report in the morning. All of that activity takes place up till about noon or 1 o'clock, and then it's curtains for the Forex market, except potentially the USD and the Canadian dollar, for example, which is a localized kind of a currency pair. But even then, be careful. The spreads will increase and become much larger. The brokers can take you for all you've got, and what might be a 1.5 pip spread during the hot times of the market in the London session or in the early U.S. session could widen to be as much as 5 or 6 pips, even for a pair like the Euro USD. So be very careful in those late afternoon periods when everyone you know has gone to sleep or is out for the evening. It's very important that you watch out for that particular scenario. Number 3 is don't enter a trade when there are wild price bar swings. It's easy simply to say, I have no idea which way this market is headed, and stay away from it. Watch out. Let me give you some examples. To give you an example, this is also considered consolidation or balancing in a range when price simply hasn't decided or made up its mind which way it wants to go. This is a chart of the Euro and the USD, and it's a 15-minute chart. So let's take a look at this particular area. Just notice that nothing has changed basically in about 3 or 4 hours. If this is a 15-minute chart, you could be sitting there all day waiting for something to happen in this area. Obviously, when we got to the London Open, we had a significant downtrend, but even then, look, a complete reversal to the north and so on. This also emphasizes the need to be sure that your risk reward is correct, and we'll talk about that as one of our other watch out points. But bottom line here is you want to be very careful in a market that looks like this, that it's consolidating, it's balancing, and it's not in trend mode. Okay, fortune hunters, we won't spend much time on number 4. Don't enter a trade right before a fundamental announcement. Unless you have been studying and studying and you have a particular strategy for taking advantage of the big wild swings. But over a period of 14 years, I have to tell you, I haven't found many that work all the time. So it's easier simply to stay out, even if it's just for 5 minutes to get a sense of the actual trend of the final outcome of the announcement. Then you can get in on a pullback perhaps, but it's best to avoid those trades, especially right before the fundamental announcement occurs. The last 2 of our 6 ways to blow an account hot list are the most important of all. We want to be sure that number 5 and number 6 are part of our DNA. Number 5, don't enter a trade without first defining risk and stop loss. You really need to be in a position to understand whether you have the appetite to accept the risk of the trade before you enter it. It might go on for 2 or 3 hours until it's completed or until your max reward is achieved. You want to make sure you can live with it for that period of time by establishing your risk right up front. We're going to talk more about this in particular, but for sure, a pullback into the bands represents the time when you can establish what your risk will be. You know exactly where that level is on the price chart, where you know your trade is gone. And as a result of that, if you can have an 8 or 10 pip stop loss, and you're looking for 30, 40, maybe even 50 pips on a pair like the GPY and the GPB and the JPY, the pound yen, you'll be in a position where your long-term profitability will be assured. Okay, traders, the last of our hot list to beware is this issue of taking a trade that's counter to the prevailing trend. It's so easy to do. Let's say that price has been moving higher and higher and higher, and you say to yourself consistently, I can't possibly believe it's going any higher. It has to back off at this point. And so you enter the trade short, only to have a counter trend trade produce maybe 6, 7 pips, and then an explosion to the north against you. That is the best way to blow your account. I know I've done it 8 million times in my early days of trading, and it's the one thing that self-discipline has finally taught me I need to avoid. Okay, traders, here we go. We have this 5 and 6 evidence in front of us. This is a chart of the pound and the yen. As I mentioned, the 15-minute chart of the pound and the yen. The date is insignificant. The patterns emerge time and time again. We have a situation here where we have our down move, and then you say to yourself, oh my God, this is the break we've been looking for. It's going to go up, up, up. And so notice, though, on this counter trend trade from here to here, while 25 pips sounds like a lot, notice that actually it's the perfect entry to the south on our first pullback after the trend changes occurred. And in fact, if we get into the trade up in this neck of the woods and sell short, we have a 53, 54 pip downward motion. And that's the kind of trade you want to be in. It's not the counter trend trade to the north. I'll also talk a little bit about number 5, risk versus reward. Notice that here, the very worst you could expect would be a move back and a double top up in this area. That would be up in the 12 to 15 pip range, which is certainly not anything to sneeze at. But look at the difference between 11 pips and 50 pips or 60 pips to the downside when you get into this particular area. That's the risk reward you're looking for. And every time you come in, you want to say, what is my risk? My risk I'm going to establish is right here. I'm not going to accept anything above that. I'm going to get out. Even if I don't wait to break the chandelier, I want to be in a position where even if I move my line up into this area here, I don't want to take out this second top. I don't want to, and I'm not going to allow that to happen. I'm never going to move that stop loss. I'm going to let it sit there. I'll enter it into my trade before I even enter and hope for the best in terms of potential reward. So that's how this game is played. I hope these 6 warnings have been helpful to you. Please check out our website at fxfortunehunter.com. Take a look at our book for more information about all of these strategies. On Amazon Kindle, The Amazing Zealander Fly Trap Forex Trading Strategy. Just search for that, and I think you'll find it a very helpful read. $3.99. We'll see you the next time. Please comment if you have a question. Please like our videos if they're helpful to you. And once again, thanks for watching.